Hey everybody, welcome back to the channel. You're here with Earl, the Money Coach. And if you've been following life insurance strategies when it comes to infinite banking, things like family banking, then you've probably heard IULs, Index Universal Life. This is a strategy that could be used, but here's the truth. Great products, but most life insurance agents don't fully understand how to have it set up because if it's not structured correctly, it could actually do more harm than good. So in this video, I'm going to talk about some of the common mistakes you see a lot of life insurance agents make when setting up a IUL, Index Universal Life, so you know what to look for, and then also you can have it structured correctly for your needs. But before we get into everything, folks, make sure you like, follow, and subscribe the channel, and check in my description. I have so you can get automatically approved on life insurances, get your HSA account set up. And for my business owners, if you're looking to secure at least $100,000 and above in business funding, I have the resources there for you. So make sure you check that. But let's get started on the IUL, but more specifically, why life insurance agents struggle when it comes to setting up the IULs. So let's talk about the biggest mistake. I'm going to talk about a couple, but I'm going to talk about one of the biggest mistakes that automatically jump out to you like a sore thumb when setting up these life insurance policies. Understand it could be used and it's a great tool for wealth building, but only if it's structured correctly. So what are the biggest mistakes when I see a lot of insurance agents making it is focusing too much on the death benefit. One of the biggest issues with the IUL is that a lot of agents focus on the death benefit more than the cash value. An IUL works best when the cash value it could grow over time, and that cash value gives you that flexibility down the road. Whether you're borrowing against it, if you want to use it for retirement and different things. But if your agent is only focused on selling you a high death benefit, they might not design that properly structured way where you can optimize the cash value growth. This leads to slower accumulation over time. And over time, your policy may not perform the way you expected it. It's about balancing the death benefit and the cash value, not just having a high death benefit so you could put in more, but balancing it. Now, the second thing is underestimating the cost of insurance or the COI. The cost of insurance is probably one of the most misunderstood aspects of permanent life insurance policies. Now, as you age, your cost of insurance increases. For IULs, if the policy isn't structured properly from the start, you could be looking at significant increases of your cost of insurance as you get older, eating into your cash value. And agents often, they don't explain it clearly. And if you're not paying attention, folks, it could lead to a policy that fails to perform as you get into your 50s, as you get into your 60s. And then also, it's not using paid up additions, the PUAs. When setting up an IUL, paid up additions, it could be a huge game changer for cash value growth. It allows you to add extra premiums that increase your policy's cash without adding to your cost of insurance. Now that's huge, but many agents don't explain the importance of PUIs, or they may even avoid talking about them altogether because it could possibly result for lower commissions. So this could severely limit the growth of your policy over time. And now another thing is overestimating the index returns. A lot of agents I see and a lot of policies that I review, they talk about a history of the performance of the index, and they're promising huge returns. But what a lot of agents fail to mention is that past performance doesn't guarantee your future results. All right, yes, the IULs are tied into different markets and you could use it properly, but understand that there are caps on how much it could grow and you could actually earn. And in the down markets, your return may not get what you're looking for. So you get the pros of never losing money, but it may not have those big returns. You want to look for something that's more realistic. If you're getting an average of 7%, 8%, 9%, it's great for you to do. Now, I always talk about this. The second big thing is a lot of agents, they only could offer one strategy. And that's huge when it comes to sitting down with someone, because I don't want you to be a salesperson, but a lot of people are like, look, if you only have one strategy, that's all they're going to push. Now, IULs are great to know, but it may be their only product that that company offers. Now that's the difference pretty much if you have a licensed agent, a broker, a captive agent, what all those things really mean. So first off, you have captive agents. All right, a captive agent, they generally work for just one company, okay? One insurance company, and they only have access to the platform that company offers. So when you're selling a policy, they're limited to whatever that company provides. So it may not be the best thing out there. It's a great strategy, but it might not be good for your needs. So if they can only offer certain IULs or certain things, the problem is they can't really customize your policy or look for the needs that you want to have the great things. They may not be able to offer you a better alternative. So those are your captive agents. Then you have independent agents, which are kind of the exact opposite. The independent agent, they have multiple insurance carriers that they could use. So they have a broader range of options and they're able to offer more solutions from various companies, and that could really be tailored to your specific financial goals. Now, independent agents, they're not limited to just one set of products, which means they're more than likely to offer you a product that fits your specific needs, whether it's an IUL or it could be a whole life policy or it could be a term policy. Now, you also have brokers. Now, brokers is pretty much kind of like independent agents, but they have a whole collection of independent agents working together. Now, a good brokerage, they will have access to an even wider variety of policies out there from many different carriers, and they'll be able to specifically tailor your needs rather than trying to sell you that one size fits all product. So you got to know what kind of agent you're sitting down with. Now, the third thing I always talk about is the importance of properly structuring your IUL. So why is that so important when it comes to structuring your IULs? Well, here's the thing. IUL policies are very complex, all right? And if they're not set up properly, you can end up paying for a policy that doesn't live up to the expectations of what you thought. Now, IULs, they're designed to give you flexibility, but if you don't structure them correctly, then they won't give you the results that you're looking for or the estimations showed on the illustrations. So here's how you can make sure that your IULs are set up correctly. Adjusting the death benefit first and foremost. If you want to build wealth, you need to focus on cash value growth, not just the death benefit, okay? The agent that you have should work with you to balance those two factors, right? So you can have a low cost death benefit that won't eat into the cash value with that cost of insurance, which brings up to the second thing. Pay attention to the cost of insurance. The COI will increase as you age, so it's crucial to work with the agent that understands how to minimize with the increases by using the strategies like lowering the death benefit for retirement or switching it to level. Because you have an increasing, you could switch it to level. So as you get older, you can manage that premium payment for the cost of insurance. And then also using those paid up additions. As I mentioned earlier, paid up additions can make a huge difference to how your cash value grows. Now, a good agent, they will help you design a plan with PUAs so you can maximize the cash value and avoid the typical pitfalls. But then ultimately, guys, regularly review your policy. What do we do every year? When you go to the doctor, you get a yearly physical, you get your medical checkup. Well, every year you should have a financial checkup. Sit back down and make sure that those goals are aligned. Your financial situation may have changed. You may be making more money. You may have lost your job. You may have to do an adjustment. Agent, when you have your life insurance, they should be talking to you at least once a year, going through a review. Now, here's the biggest problem: social media. Social media, it is a huge cancer into the life insurance industry. And why do I say it's such a huge cancer and a huge issue in today's social media world? Is because you have all these influencers. With everyone turning to influencers for financial advice, you're seeing a lot of misinformation about insurance products like the IULs. And here's the problem. First off, oversimplification. Social media, you only have a certain time. You cannot promote or talk about these strategies within 60 to 90 seconds. The truth is, life insurance is a long-term strategy that takes careful planning, patience, and understanding how it works. Influencers, a lot of times on social media, they make it sound like you could just buy a policy and start using it as a bank or as an investment. First off, it's not an investment, it's a saving strategy. So that's not how it works. And then the second thing is it's a lack of regulation. A lot of social media influencers are talking about infinite bankings or IULs. They're not even licensed professionals. They probably have an affiliate link. They might not understand how complex a product is, and they're promising so much that you can't get, but leaving out a lot of details like the fees, the need to have a structure, cost of insurances, all that stuff, and then over promising results. If you see someone claiming that they have a policy and they've made hundreds of thousands of dollars in the first few years in their insurance policy, it's important to understand that a lot of these really probably didn't happen, or they're often outlining some kind of success story. Understand, if you have a great success story, you're probably going to have a lot that didn't work as well. IULs are not a get rich quick, it's a get rich slow. You should have them when you really start seeing cash value is, 8, 10, 15 years into the policy, or unless you're chunking a huge amount up front. So you can use it like a family banking strategy, but if it's not structured properly, what's going to happen in the following years? So yes, it's a powerful tool for having a wealth building item in your portfolio, but unfortunately, too many agents don't understand how to balance it out. And put it like this, IULs and insurance in general, it shouldn't be the only thing in your portfolio. It should be a supplemental income. So you have a 401k, your IRA, your life insurances, your stocks, your crypto. Put all that stuff together, and have a proper portfolio. But if you're looking to make sure it could be done correctly, make sure you have an experienced life insurance agent. Make sure they can sell all different kind of insurances, not just one that they're trying to offer to you. And always remember, don't fall for someone that has it and they simplify it so easy. It's not just a simplified product. It's something that has to be looked at, dissected. Make sure you understand how it works, the cost of insurances, the penalties if you want to touch everything. Make sure you follow that. So with that being said, folks, I hope you enjoyed the video. Make sure you like, comment, and subscribe, and click on the link below for some of the things that could really help you out for building your wealth or even getting your own insurances. And I'll see you next video. Take care.